As I continue to work on my portfolio, it's time to cover UWM Holdings, the mortgage company the market seems to love to hate, especially recently. I'm going to explain why I've not only held my position, but why recently I've actually bought more on the cheap. Here we go. So UWM Holdings, the number one wholesale mortgage provider that was supposed to take the market by storm, providing the best rates and becoming the number one overall mortgage provider, at least according to CEO Matt Ishbia. Where UWM differs from competitors such as Rocket and PennyMac is that they use the broker model, with their customers being mortgage brokers who find loans and use UWM to underwrite them. I've covered the stock a few times and I've highlighted how much I like the company's investment in technology, namely the streamlined applications that reduce business overheads, meaning they can offer better rates and provide an interactive service for customers. One frustration I frequently pointed out was their mortgage rates were unnecessarily low, being just a fraction of their competitors, reducing their production margins and profit. However, this seems to have been a business tactic to increase their market share by undercutting the competition.
The margins didn't collapse. I controlled the margins. I dropped the margins to focus on putting a lot of pressure on my competitors, which we did successfully.
It's a similar tactic used by Amazon, who have a reputation of undercutting smaller competitors, even taking a loss on their products to steal their competitors' customers and prevent their growth. It's a dirty tactic, but it's worked well for them. Just check out what happened to Diaper.com, for example. In UWM's case, this seems to have been very effective in regard to growth in their mortgage loan volume, and they have remained second to Rocket Mortgages. On top of this, the company has been consistent with their dividend, paying 10 cents per share for the last 3 quarters, which is likely to continue into quarter 4, and despite seeming lower than their competitors, it actually represents a dividend yield of over 9%. Which beats them all hands down, especially Rocket, who don't offer one.
No money, no honey.
So the question is, why a stock for a company that seems to be doing so well and offering so much has been delivering so much pain for investors? Firstly, UWM started off via SPAC merger and developed a cult following as a meme stock. And these types of stocks have come under serious scrutiny for their pumped up speculative offerings and poor performance over the last year, with the majority of SPACs being toxic and meme stocks were generally disasters that benefited the company more than the investors. Charlie Munger recently compared meme stocks to a drunken brawl. Last November, UWM's controlling shareholder, SFS, announced plans to issue a secondary stock offering which would increase the public float by 50%, increasing liquidity and tradability for institutional investors. The market reacted badly to this, with the stock crashing 21% on the day to a 52-week low of $5.52, a price Matt Ishbia was not prepared to sell at, so he U-turned on the offering. Investors clearly agreed as the stock bounced back on the decision, but it's been falling ever since. With UWM being one of my largest and covered positions, I was pretty annoyed with this move.
No! God, please, no! 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 No!
Given how UWM stock was performing at the time, having plummeted 57% year to date, diluting the stock further was a betrayal of investors and severely damaging to the company's reputation. The company has tried to rebuild trust with investors by accelerating their buyback program, with UWM planning to spend $100 million on the shares SFS was preparing to sell. Still, recent insider trading activity has around $102,000 of stock sold from key employees listed on 2nd of February. The amount is minor compared to the insider buy-in from 2021, but isn't great for investor sentiment. In January, they announced their Chief Business Officer, Blake Colo, will take on the additional role as Head of Investor Relations, in the hopes that his 15-year background in the financial industry and relationship-driven mindset might improve their reputation with investors. The stock continued to fall though, suggesting investor loyalty isn't so easy to earn. If we consider the 2008 mortgage market crash, this was a result of mortgage suppliers, brokers and retailers using creative mortgage models to sell too many mortgages to too many people. The market was a bomb waiting to go off, and it did, with the result devastating to homeowners. Check out The Big Short if you haven't already. So the idea of innovative mortgage companies such as UWM using new models and new technology can ring alarm bells to shareholders during periods of market volatility. With the Fed announcing increased rates, mortgage companies, along with fintech, are losing favour with investors. Still, if you look at the average mortgage rates for the last 5 decades, overall they have never been lower. So even if the rates are going up, recently been reported to as much as 4.25%, the effect this might have on the long-term mortgage market may have been exaggerated. UBM believe that they have the right model for the current market, and Matt Ishbia has claimed repeatedly that they will take the lead once the mortgage rates rise.
Wait till rates go from 2.99 to 3.5 or 4% next year, and we're going to grow. We're going to dominate in the mortgage space because we dominate in purchase.
It looks like he's getting his wish, and as rates increase, this means lower loan volumes and a shrinking market. Success or survival will be highly dependent on who can offer the most competitive rates. UWM have already shown how low they can go, and they might be one of the few companies benefiting for the 2022 mortgage market. UWM's revenues show just how cyclical the market is, and the results from 2021 are a shadow of 2020, which had reported record numbers. But this seems to be a result of the company dropping their loan production margins to undercut their competition. If we look at Q2, where they first dropped their gain margin by almost 67%, down to a rate of just 0.81%, they were the lowest in the industry by a crazy margin. If we then compare this year on year by their closed loan volume, we have a 90% increase, beating Rocket, PennyMac and Wells Fargo. If we then apply the same logic to Q3, where UWM used a slightly higher rate of 0.94%, which is still a 70% reduction from the previous year of 3.18%, UWM still reported a 16% increase in closed loan volume, beating competitors again, with Rocket down by 1%, Wells Fargo down by almost 16%, and PennyMac showing just a 9.12% increase. And despite these rate drops in Q2, which saw an obvious reduction in income, we can see that their Q3 saw an increase of 42.4% in revenue. Their profits climbed almost 138%, and that gives UWM the fastest rate of growth in the industry. Their costs are stable, so they could continue with this method of operation and have plenty of room to increase their rates at their leisure, which I assume will increase as they gain more market share. I find it interesting when looking at the financial charts just how much UWM seem to follow similar patterns to Rocket, just on a smaller scale. This shows how both companies operate similarly, but conditional to the same market conditions. As for the stock, UWM seems to have found some support this week, bouncing off the $4.28 line and now trading just below the $5 mark. Short selling interest has been falling, suggesting a level of support and possibly the bottom of a teacup, which is an ideal buying opportunity. With the Q4 earnings due on the 1st of March, it won't be long before we can see a more informative move from investors. UWM continues to operate as one of the largest mortgage brokerage firms in the US, with a market cap of around $7.5 billion and trading at 0.34 times earnings. With a 9% dividend, the negatives seem to have been priced in and the stock seems undervalued compared to the competition. Analysts are predicting UWM could see a 50% increase in earnings for 2022, while by comparison, Rockets is predicted to fall by 37%. The mortgage market is cyclical, and some volatility is to be expected, and combined with massive rate hikes, huge negative media attention, and Russian tyrants threatening to invade Ukraine, is not a great time to own any mortgage or fintech companies, let alone one with controversial market behaviour. I subscribe to Warren Buffett's philosophy that when it comes to investing, you're not buying a stock, you're buying into a company. And when you follow this model and do your research and you buy into the stock of good, undervalued companies in industries you like and understand, it's much easier to tolerate a price drop. Where UWM and Rocket have both taken some punishment over the last few months, I've held my UWM position, which meant taking some punches to the tune of around 20%, because I think UWM's business model is ideal for the strained industry and they are likely to do very well throughout 2022, with the stock improving once all fear over market conditions has dissipated, meaning now is the ideal time to buy on the cheap and take advantage of the best dividend in the sector. Now I just bought another 10% in preparation for a Q4 report where I expect to see more details of their stock repurchasing plan and earnings that will cause investors to reevaluate their positions in a positive light. I plan to do a full financial segments once I have this information. Now that's my take. Do you agree? If you have any thoughts or stock you think I should be covering, please comment below, let me know. And as I continue to cover my entire portfolio, consider subscribing so you don't miss out on future videos. Until next time.